so we can do that. And I don't know if you want the autopilot record. There we go. This is part 1, the new year. I got some interesting stuff for you guys. I think it's going to be awesome. It's I always get excited about doing this stuff because it helps me to prepare better even for my own trade. So it's kind of a nice way to kick off the new year. And boy, what a way to kick off the new year we've got going, right? Anyway, we got some exciting things happening here. And as far as markets, I'm going to give you guys an invitation for my weekly thoughts and observations. Before we get started, let me just tee up the recording. That's the biggest problem I've got going on here. It's not 15, it's 16. I don't know if anyone's written checks. Not that I've written a check, but I mean, just putting down 2016 is bizarre. Just remembering to put down 2016, another year. All right, so we have started the recording, and that is kind of nice. So the recording is moving. This is awesome. Welcome, everyone. Happy New Year. I definitely wanted to wish everyone a success for this year. Got some neat things happening in the marketplace, and like the slide says, we're going to begin promptly at 4:36, not 4:30. There's a typo there. I'm sure it's a typo. Any event. Take a second. We need to put out a disclosure for you guys. And again, one more time, let me double check. Is there quality sound? Does the sound back, the quality sound? You should have audio and visual. Good sound. Incredible. Awesome. All right. First and foremost, I wanted to say, if you're interested, I put this out, my weekly thoughts and observations. Some of you used to maybe get them. We'd send them out in an email as a courtesy, just as a kind of to see what was going on in the world. And we would then post them on our blog. But then we kind of did a little bit more serious stuff, and we put it out in to our room community. So with that said, this is the current weekly thoughts and observations. There's a lot in here. Obviously, figuring out where the market's been, number one. If you want to figure out, as I was always taught, if you want to figure out where the market might go, you kind of got to ask yourself, where the hell has the market been? Here's where we've started the year off, the tally for the year, some major technical points of interest and analysis. We talk about weekly. These types of indicators is something we'll go over in part 2 for next week. This week, I want to get a baseline for us and go over some things, because I know that we are on the cusp of what many feel is the beginning to the end of the world, or are we really in a changing of the guard of sectors, and just maybe the market is this, as someone has already posted. What was the posting was, thank God for options. It's very choppy. I think it says it's a choppy market. Thank goodness, not thank goodness for options. Nice post there, Rick. So obviously everyone has discovered there's a little bit of volatility and choppiness in the market, which is indicative of not a bull market, not a bear market, but a consolidation phase, which is more indicative of a what? A market corrective phase, right? Corrections occur in two ways. Markets move sideways or lower sharply, and that's a correction. So with that said, we definitely have a couple things. This, I've been asked before to explain it. It's just an anomaly that I uncovered and I discussed it in my first book. I'll show you in a second. Over, I can't believe it's 11 years ago, 12 years ago now. It's like, God, I know I'm getting grayer as every year goes by, but it's becoming, and some of you we've become closer to as the years have gone on, and gotten to meet a lot of people face to face. And we're still doing the same old thing. Nothing's really changed on our person's planet, quote unquote here. We continue to do the same indicators, and it seems to be very useful and helpful for us around here. This December 9th, if we're going to see a meaningful breakout, and that's that line means, a bullish breakout, we need to get above the December 9th high. So the 9th high, a daily close. I think everyone can understand what that sentence completely means. We need to see a daily close in most of the top stock indices above the December 9th high to see a meaningful upside momentum move. All right. This is some other information here just to kind of illustrate the market's neither bullish nor bearish. We have more stocks near 52-week highs in the S&P 500. In other words, 96 stocks are near 52-week highs with 30 near 52-week lows. I think if the market was due for a rolling over and crash and burn dive, and this is it, the end of the world as we know it today, I think those numbers would be reversed. Notice that we have exactly almost 50% of the stocks, a little over 253 names as of last Thursday, the year's closing trade. 253 stocks in the S&P 500 were above their 50 day, or excuse me, 50% of the stocks were above their 10-day moving average. So from a technical standpoint, it's not a half, I mean, depends on your outlook in life. Is the glass half full or empty? It's half, right? Any event, one of the things that I thought was interesting is that the small specs had been flipping back and forth, long, short this season. And coming into the new year, they were actually net long. And I don't know if they're as net long after yesterday's wipeout as they were a week ago Tuesday. And the hedge funds and the commercials are net short in the commitment of traders' data. Anyway, I think one of the things that we just started up as a heads up, I think this year, until we get a more meaningful move, we're probably going to expect to see muted upside moves in a lot of the markets here. I do believe that we have other names that are, and it's a little late now for you guys, but these are the top stocks that I felt were due for technical, seasonal, and other factors for profit-taking corrections. I mean, Amazon, and it already has seen that though, right? I mean, we started off the New Year Monday with, a little downside in Amazon. Other stocks that I like to look at that have a potential for upside, besides Apache, and of course CNX is another energy. So you'll notice a lot of energy in there. These are things that we kind of put out, and again, here's, as we scroll down, some seasonal spread trades for what we start off for the month of January. These are for commodity traders, but for Forex traders, I think you might find this interesting. Last year, every year we post this. Last year, this was posted before it happened, and believe it or not, if you recall, the Swiss bank, what did they do? They adjusted interest rates, and it just like the currency just debacled, and it caught everyone off guard. This spread, actually, whatever side you took, long Aussie, long Canadian versus a Swiss franc, was an amazing, it was a godsend coincident factor. But I think on a year-end, year-over-year basis, from a seasonal perspective, it makes sense to see a rise in as I'll explain in a minute, maybe what could cause Canadian to go up and the Aussie to go up. But for foreign currency traders, you may want to follow the performance this year. If we do see a recovery or a bounce off the lows here in energy, you might see a little bit more upside in the Canadian relative to the Aussie dollar. So something to pay attention there. This week, starting the week off, my Lord, coming into this week, friends, you want to come off a vacation with just easing into things. And I'll tell you what, this is being recorded, Bob G, and you do have, if you got an email invitation, here's the great news. This weekly thoughts and observations, I'll send this out to you guys by email in a PDF. I think that would be appropriate. If we send it to the entire database, I don't know who signed up, who didn't, who wanted it. So we'll send it to the ones that attended. So Bob G, man, you need to take your wife. That's awesome. Thank you very much for your post. We'll see you next week possibly. This is, again, a two-part webinar because I can't put everything in one hour time period to prepare for the year or thoughts and things that we want to cover. All right? So don't worry. In addition, this week, tomorrow, besides looking at the U.S. markets, we are so globally interconnected, we need to pay attention to not just Europe, Germany, we have to pay attention to what's happening in Asia. And quite frankly, tomorrow we have, besides ADP coming out, the Euro Producer Price Index. Now, tomorrow morning, I don't think Producer Price Index is a big deal in the Eurozone. But one of the things that is going to be a big deal, I think, cause a little bit of volatility. You're probably all aware of it, but just in case you're not, it's this FOMC minutes of the last meeting. We're probably going to dissect this to find out, what the thinking is. What was everyone looking for? Were they looking for a half a point? Were they looking for a full point? Did they think there was a lot more room for higher or stronger rate adjustments? That's what's going to be contained tomorrow at 2 p.m. So hang on to your seats. And again, on Thursday, the Eurozone job number comes out at 5 a.m. and the Eurozone retail sales comes out at 5 a.m. So before we even get through Thursday and walk in here, we've got a European bombshell to contend with. And then, of course, we have our job number, and that will be important. And just in case you're not doing anything on Friday night, China's Producer Price Index and CPI comes out at 8:30 if I didn't get that wrong. So I just wanted to let you know there are some things that are happening this week, big things. So as a disclosure, take a read off of this for a quick second. It's pretty much an important disclosure that states that trading is risky. This is for education and purposes. It's for your benefit. It's not to be republished, recopied, or put in any commercial way. It's just for your benefit as individual traders. All right. So a bit of history. Many of you have been around. You know I'm not going to give you the long of it. I've been around too long now, 35 years as active trader since 1980. First started at the floor of the Merc in 1977. It's just amazing. We started to do this thing about cleaning out the office, and we started like old boxes stuff. And I mean, I got some antique things that I just never wanted to let go. One of the things was an old timestamp machine. When I owned a brokerage firm, we kept one of them. I don't even think they're used anymore. But the funny thing is we've seen so many changes in technology from Windows 95, if you remember that one. I mean, you can keep going on and on and on, but now we got Windows 10 to work with. But one thing that's been consistent is this information that came out of that book right there, which really helped popularize pivot points around the globe. And that book really set the stage, and it also had some amazing things in there, like we discussed the last conditional change concept, the high close, low close doji, and those are so powerful we created scans for them. And then a few years back, and I can't believe it, but Mastering the Stock Market came out, where I revealed to the world why there was such a strong benefit on using specific volume tools relative to using volume histogram. That book also went through, and it was released in 2012. It talked about breadth analysis. It talked about seasonal sector analysis. Really some powerful stuff. And again, I had a little bit of experience in commodities, to say the least, and we were co-author and editor of that Commodity Traders Almanac. If I had to have anyone ask me, if you were a stock trader and someone said, John, if I want to learn your information, what would you recommend? There'd be no doubt that I would say this would be the only or the last bit of work that I ever write. There is no need to rewrite the work. Mastering the Stock Market is probably one of the best books for describing seasonal stock, breadth analysis for stock, volume analysis for stock, and how to run scans. Especially if you're a Thinkorswim user, there was a chapter there about running scans on Thinkorswim. So it's really a powerful book, and I can't tell you, it is, if you're ever interested in learning more about my stuff, that's the book to get, okay? So let's just kick it off, and I'm just going to cut to the chase. Here are some of my predictions for 2016. I see crude oil going to 45 before we see 30. Now that's if you know where crude oil's trading, it's at 36.16 in the after hours or trading. That's where it went off the board, 36.16, and you go, John, you're handicapping the market $6 move to the downside. You're handicapping it to the upside, which is a $9 move. And I think that in the next few weeks, we will probably see in this time frame, we will see crude oil trade to 45 before we see 30. I think that's, and if I'm wrong, it's only going to be by, maybe we'll miss it by $1 or so. But I think we're going to see 45 before we see 30 in crude oil. Gold this year before June will trade back under $1,000. And over the next few weeks, from a seasonal perspective, crude starts to peter out in its seasonally strong period of time. And I just think that the gold trade, it really wants to go and round numbers, and there's nothing rounder in this world than $100 or $1,000. I guess $500 is a round number, but 1,000 is a big solid round number, and that $1,000, there's some technical areas of interest near that 1,000, particularly 980, 972 to be precise, that I think gold sees a move back down. All right, I'm long Twitter. I have some wide verticals on, so as a disclosure, I probably should let you know I'm a little biased, but I think Twitter actually trades before June back near 35. Twitter has, as a stock, if I was going to put anything out there, I mean, why Twitter? Because I always found it fascinating to find a stock that the U.S. Justice Department used to send a press release out by using Twitter if it's good enough for the U.S. government. And, everywhere you look, everyone wants to be liked on Facebook and everyone wants to be tweeted or send us a tweet or tweet us this. It's a matter of when they get the release of, monetizing the product. It's very similar than the early days of Facebook. And we all saw what happened with Facebook. They finally did monetize things, and the end of that story. So Twitter, I think this is the year that we start to see an interest back, and before June, by the way. So considering the fact that Twitter's trading, if you also take a look there, if you are a stock trader, you may think that I'm crazy, but I think Twitter has that potential, and I'll even go out to say I think Twitter trades up to 35 before it trades down to 18. That's pretty bold. Also, wait, John, what are you doing? You're killing me. I think the S&P 500 trades back up to 2080 before we see 1940, and I think we see 2080 before February 15th, and that's a pretty bold statement. What is that bold statement based off of? Stuff we're going to go over today and things that we're going to go over next Tuesday. All right? And that's a pretty bold statement to state, especially ahead of tomorrow's minutes of the FOMC and, of course, Friday's unemployment report, or jokingly, as we say, the unenjoyment report. All right. So I also believe that we'll possibly see one more rate hike, and there's a bunch of ifs. So let's take a look at the ifs. All right? If China's economy picks up and we see global equity markets recover, then I see Fed raising rates one more quarter point at the June meeting. The next meeting's at the end of January. I think it's January. If I'm not mistaken, friends, I think the next FOMC meeting is January 28th. I apologize for not having the exact date factual in front of me for this presentation, but I believe it is, the next one's January 28th. I think they let a couple quarters, here's my thought process there, I think they let a couple quarters go by. So you got January, February, March, then you got April, May, with enough monthly unemployment reports behind them, with enough months, almost 6 months, to see if other global economies are improving as indicated by maybe equity prices as well. Then I see one more quarter point rate hike by the June meeting, and there is a meeting in June. So here are some indicators and indexes to watch that I think will be very important, even if you're a staunch, I wasn't going to say political comment, I was going to say if you are a staunch technician that really doesn't focus in on, and I don't think there's a staunch technician that doesn't understand or follow what's coming out on a fundamental aspect. I don't think there really is. I think you need to have an idea of what's coming out regardless, but you believe in your technical indicators. And the opposite is true. I don't think there's a single fundamentalist, even though they claim they don't like charts, they still watch charts and they look at them. So let's just say if you're going to look at some of the indicators, if you're not familiar, just put up on your watch list every day the FXI. It's the large cap China ETF, exchange traded fund. It's dollar denominated, and you can look to see where it is and trading over a period of time. It doesn't look pretty right now on a daily chart. Longer term monthly, it's at a basing, and I'll share that with you. Actually, if you'd like, I'll share that with you right. Should we do it now? Why not? So let's take a longer term look. So here's the FXI. Relative to its high at the beginning of 2015, as it was coming off of that enormous blow-off top, it had a little bit of accelerated downside, and note where we're trading right now. We're trading, as I pointed out, on a daily chart, it looks ugly. On a longer term chart, we're at the bottom of the base. I mean, we're actually, you know, a little bit better than the bottom of the base, right? So I guess as you'd want to just draw a simple little trend line and say, you know, it got a little over accelerated. Maybe it's a little undervalued at this point in time. Longer term analysis, my momentum indicators is starting to show that bearish decline is waning. Now, you're not seeing funny things. This is where it closed the year, and this is the gap, and this is it opened here, and it's trading lower. As long as 3280, it's this white line in the sand, you can see it on my charts. As long as that 3280 kind of holds, that white line in the sand, I mean, we could trade a little bit lower, but I think that the FXI, the China ETF, that's kind of, if we see a recovery there, then I think we're, you know, more prone, and a recovery could be just at the, you know, the top end of this last, say, 6-month range of 41 on that ETF. So from 32.80 up to 41. Those are, you know, if you take a look at the market here, or if you just exclude last year's in 2014 and 15's run up, if you exclude that, looking at the charts, I mean, this is pretty much, take this off the table. I mean, you can even go back in time, right? I mean, this is probably the more prone valuation level of the market. It wouldn't be unrealistic to see, as I've just defined it now, to see the market get back to 37, 38, or at the top end of this range. We would obviously be very, very concerned if we started to see a breakdown and a close on a monthly basis underneath that white line on the sand with an increase in volume. I would be. But as it is right now, very similar to over here, where the market had that same similar type of upside, breakdown, chop back and forth, got everyone all scared. The momentum indicator started to reveal by seeing higher low readings, the red line. See, each red line's making higher lows. It's starting to move up as the market didn't actually move anywhere, right? So it was showing that negative force was dissipating, and then it had an ensuing recovery. So FXI, those are the levels that you want to be paying attention to. Put it up on your charts. I think that makes sense. You know, last summer, the media, just to take you down memory lane, Remember the media was talking about Greece, Greece, Greece. It was all this about Greece, and we had riots in the street, and every time we saw a riot, the market went down, right? I'm sitting in Europe. We were in Italy for a vacation over the summer, and, over there, they weren't, people were like, oh, Greece, no problem. Tourists and Mykonos, they can use credit cards, and it didn't, cash station machines. It didn't make sense what was being on the news, what the news was portraying, and what people were saying. Oh, we were just there, and not as bad as what this media is saying. The real problem, though, is China. And so no one was really giving China any credit until, of course, August 24th, and that, big downdraft in the market changed the scope of everyone focusing on China. But I think China's stock market, as well as the other global markets, Germany, for example, are going to be important. So that's why I listed some indicators and indexes to watch. Instead of watching all of them, the key ones to pay attention to would be the FXI for China. Next, here in the U.S., watch the leading economic indicator, LEI. If there's ever a time that you're going to be focusing in the plethora of reports that come out that we get bombarded with, I really feel that the leading economic indicator will help define whether or not the economy is starting here in the U.S. to soften, like the R word, right? The recession word. If we start to soften, that's going to be, a big if. If we see a softening, then there's not a chance I see the Fed raising rates. But if the LEI starts to heat up, I would be more prone to see not just one more rate hike, but I would be more prone to see potentially at the end of the year, if leading economic indicators picks up, if the PMI, Purchasers Manager, picks up and gets over 56 for multiple months in a row, for example, then I would say we could see Fed funds on the increase. These are the important areas of, if I had to sit there and say, John, you're going to be on a desert island, you can only get four reports. We are only going to let you see 4 reports. What are the 4 you want to see the most? I want to see what China's market's doing. I want to see leading economic indicators. I want to see the ISM Purchasers Managers Index. I want to see the unemployment reports, if I could, here and central in the Eurozone. Those are the wonders. Those are the ones that I want. Okay? So those are my single solitary island, so to speak. Like they always say, if you're on an island, what album do you want? Some people say it's the Eagles, Hotel California. Some people say Grateful Dead, Europe 72. And some people say it's Frank Sinatra's greatest hits. Whatever. So with that said, I think another thing that's going to occur this year, this is kind of off the cuff, by the way, I think we're going to see more hedge funds shutting down in 2016. We have the current number of hedge funds is excessive. It's like how many people can, like the mortgage crisis, it's at a bubble, right? We have like 15,000. And with this last week, more redemptions are coming, and it may put pressure on the market. So given the current rate for hedge fund closures, I think we're going to see an all-time high closure rate in the next 6 months. Another rate hike and more confusion in the markets. Confusion in the markets meaning we've got, and I'll get through exactly what I'm saying in just a second. I've got all kinds of great charts set up for us. Bonds aren't crashing. Stocks they're kind of in sync. Rates went up, but interest rates aren't up for deposits. In other words, rates went up to charge the consumers, but if you make a deposit, you're not going to see that quarter-point rate hike affected in your account. So earned interest payments aren't being affected. So there's been, just as a very simplistic thing, there's a lot of, for some traders and new hedge funds that were put together, they just don't have the makeup for riding through this potential change in investment climate that we're in. And this is a change. And I think what you'll see, and you'll listen to this, redemptions, which is another way of saying send me my money back home, it can cause short-term turmoil from asset liquidation. Increased volatility is what that means on a short-term, keyword, short-term basis. So when a fund shuts down, they have to close out their positions, send the money home. Where's the money going to go? It's not going into a mutual fund. It's not going to go into a CD. So until there's more clarity on interest rates, and I think until there's clarity on new changing of the guard, and here's my drum roll, please. Here's my other prediction for 2016. Are you guys ready for this one? Are you ready for my next major prediction for 2016? The suspense is killing me. We're going to vote for a new president. Bring it on, baby. We're going to have, and we're going to vote for a new president. Someone just said, please no polls. I don't have a poll, but just keep telling yourself you're going to be too positive to be doubtful no matter who's in office. Don't worry about it. You're too optimistic to be fearful, and you're just too damn determined to be defeated. Just remember that. All right. That was just a little icebreaker there. All right. So here's the thing. No, Steve says, is there going to be a real estate crash again? You know, wait till you see what I have in store for you, Stephen. Nice post. I appreciate that. Business cycle, the big picture. You know, I wrote about this, and this is actually plagiarized from my own book. You know, we definitely see a business cycle, and I mean, to be honest with you, in typical past historic times, we would see in an early expansion phase, financials, transportation, and technology start to pick up as we got out of a recession. As we get into a middle to a late expansion phase, we'd start to see capital goods, basic materials, and energy pick up. Okay, well, capital goods, basic materials, which would be perhaps what? Industrials. I mean, this is like the old school business cycle, the big picture. Where are we in this cycle? You know, consumer staples and utilities. Well, obviously, when the market starts to see a contraction and we get into a contraction, people start going to safety by buying utilities and getting into consumer staples. So what do the charts say? Where are we with these specific sectors? And so that's what I wanted to kind of look at. When people look at a daily chart, and this is the key, friends, I think that we definitely don't look at bigger pictures as often and higher degree time frames. Many people only look at daily charts, and they don't look at the longer term trend of the market. So what I wanted to do is say, all right, maybe we can get some answers to where we are in the business cycle by looking at the reflection of some of the top sector ETFs like the XLK, which, as you know, have a few names in there. You've heard about them: AT&T, Apple, Cisco, Google, Hewlett-Packard. I think with the split that might have changed, Intel, IBM, Microsoft, Oracle, Verizon. It's mixed. It's not a specific, it's a broad-based sector technology. It's not subsector specific, I guess, would be with computer hardware or semiconductors, right? But when I look at this chart, I go, you know, it struggled to maintain a rally and sold off, struggled to maintain a rally, sold off, struggled to maintain a rally, sold off, and we come back up here and we made a new high. And, you know, when we take a look at this chart, one of the things that you all might notice is that this volume looks resoundingly like a rounding top pattern. This is the indicator called on balance volume. Even my little momentum indicator here on a weekly chart suggests that the market got a little overbought and it's in a sell mode, and that's what that reflects. So this kind of looks ominously topping to a lot of traders. I mean, let's face it, if I drew a line, it almost looks like if I threw a plate over it, it almost looks like a curvature rounding top formation. Well, this is, if we go back and we look at a monthly chart, all we see, rather relative to a rounding top, is a huge or longer duration upside trend and a choppy sideways condition. So In fact, looking at the volume analysis in the technology, this market is actually correcting itself. It's correcting itself by being, as someone has already identified in the room before we even began, says, boy, this is a choppy market. So that's what this really is. It's a choppy market. It hasn't been able to maintain any closes over specific highs over the last year and a half. It just hasn't been able to. So it has had no follow through to the upside. This is the transportation sector. You look at this thing and you go, oh my God, it's the end of the world. It's crashing. It's getting ready to puke. It's been puking, and it's puking even more. The momentum indicator. You see these, as the market's making newer lows, note that the momentum indicator is making higher lows. So I look at this and I go, well, you know, we need the transportation sector. We need, of course, airline stocks have done well. They've given up some of their gains. Rail, trucking. I mean, didn't Amazon ship a boatload of stuff out? And didn't we send a whole lot of stuff by shopping online, supposedly? So what's UPS and FedEx's problem, right? Energy prices are down, so they've got to be making money. Wait a minute. Let's go and look at a monthly chart. So when we look at the short-term analysis, it looks pretty ugly. Looking at a weekly chart, it looks pretty ugly. When we look at a monthly chart, and I look at this, the pullback, the correction that we see looks fairly muted compared to that stellar rally that we saw in 2012. Now this goes back, as you can see, since 1997. This is the transport index. So while in 2007 and 2008, we did see a correction, and it did crash, and it got ugly. We got that. We understand that. Then we got another one in 2011. We understand that. But this transportation sector has been under pressure, and it has been in a correction since it peaked out in 2014. It's already been in a correction. So it's not like the correction's beginning. It is probably a later stage correction in transportation. So if energy prices continue to, even if we do see an uptick in crude oil at 45, there stands a chance that a lot of these transportation companies are still going to make some hand over fist cash. So I think what the key is, even looking at this downside action in the transportation sector, the momentum indicator is saying that it's starting to run out of negative momentum. This is the financials. I look at this chart. You probably see this chart, and you see the same thing. Every time it rallies, it sells off. It rallies, it sells off. It tries to rally, sells off miserably. Tries to rally, can't hold a rally. Kind of looks pretty negative. Volume analysis looks pretty, I don't know, doesn't look pretty. It looks ugly. If you were a bull, this looks ugly. If you were a bear, you're thinking, well, why won't it go down even more? Well, let's take a look at the financial sector. This is a monthly chart. If we go all the way back since 2007, before the Lehman and of course Bear Stearns and the banks and the crisis and all of that, note that we had a longer duration upside trend, and all this thing is doing is sideways. So this does not give me the indication that we are crashing and burning. It's telling me more of that we've been in a pause, and we have been in a correction. And pretty much since late 2014, we've really gone nowhere. Since mid-14, it's gone nowhere, but actually sideways. Now, if you bought it up here, you're losing money, right? So I look at this and I look at the corresponding volume. I go, well, with the market selling off, the volume didn't really move down. So I got to say the financial sector still looks, it does not look as negative. So the markets here, are we on the cusp of a market crash to biblical proportions, or are we in a trading range? And some of these top sectors, as I wanted to reveal to you, and again, this is materials. And the materials sector, of course, we had that little thing with Dow and DuPont. All right, fine. But looking at the materials sector, and of course copper prices, and of course gold miners are you know, those types of markets, and Alcoa, of course, are in the XLB material sector. I look at this and I go, man, it's already corrected. It kind of is already corrected. It hasn't really gone anywhere. This is the one problem I see. There hasn't been a real expansion in over 7 years. I mean, literally, talk about going back in time. If you bought this high right before the big crash, you're just about breaking even. It's just been 7 years of wasted money. Nothing's happened. So is it overbought or oversold? This is the industrials. So the industrials, and again, when we look at these ETFs, there is a consideration we have to think about when we're gauging valuations. If you want to figure out where a market might go, we've got to ask ourselves, where have markets been? What markets? Well, let's talk S&Ps. And with the S&Ps, we need to find out, in the S&Ps, we need to find out what makes the S&Ps tick. Is it just drug stocks? Is it just financials? Is it just crude oil, energy? No, it's everything. And there's certain sectors that have various weights. And it's not just the pricing action, it's the condition. If a market had already had an incredible rally, especially the industrials, I mean, if you listen to the news and people say, boy, the industrial stocks aren't doing well. Well, if you bought them last year at the high, you got a point there. But actually, they're not far off their highs. If you bought them 2 years ago, you're like raking in the dough. And when the market sold off, it hasn't been able to take this shelf of support, these lows out. That was in the August sell-off, by the way, which immediately bounced right back with a sharp volume vengeance. So I look at this and I have some good news. I can't throw the baby in the bathwater out. Someone had asked me about real estate. Well, we covered this today in the room because in my scans today, I was noticing a whole bunch of real estate investment trusts were popping up. And I would think the last thing that I want to invest in, if the stock market's going to crash, if the economy is going to contract, would be real estate investment trusts, especially in a rising interest rate environment. But if you take a look at this chart, and this is a weekly basis, I mean, we are seeing an upside move, but with an attitude of volume behind it. So perhaps there is more to, and this is the VNQ, by the way, the Real Estate Investment Trust. It's an exchange-traded fund. And this is something that I find appealing for me as a trader, that, okay, besides looking at the regular cast of character indicators, you know, your stochastics, your MACD, your Bollinger Bands, and you know, everything else in Fibonacci that everyone seems to be looking at, right? And those are, if you think about it, Bollinger Band, Fibonacci, MACD, stochastics are all one price-based indicator. They're based off the price of the structure or the market that one is looking at. So if you're looking at S&P 500 and you're looking at those price-based indicators, they probably don't reflect great things. And then we start, you know, getting prognostications about, it's overbought, it's due for correction, the market broke support. When I start looking at what makes up those markets, I go, you know what? If we were going to crash and burn, then at least now, I think we would see more or bigger or stronger deterioration, especially in the sectors that I just went over with you guys. And we don't have that yet. So that tells me we're in a trading range. So maybe perhaps we're at the base of the trading range. And after we get through what traditionally, if the larger valuation names like Amazon, Facebook, the FANGs, let's call them, the Netflix, the Googles, if they're the ones that, you know, accelerated the upside and everyone's invested in them, after the brand new year starts and you sell and liquidate and take a profit on those, you defer your tax liability to April of 2017, especially if you have enormous profits, right? So again, the point that I'm making is a few names don't make up the market. Sectors, it's not just one stock or four names like FANGs that create whether or not we go long or short. I think that we have a change of scenery in the landscape of the markets. One of the other indicators that we try to focus on, which will be in part 2, of course, will be what I like to look at, my breadth analysis, which I'll share with you. We take a look, and many of you have been around long enough or you've seen me before. I look at the analysis, the breadth analysis, and we're just scraping the bottom of our trading range. This blue line in the S&Ps, while we're not going, can't penetrate the resistance, which is the red line, we can't penetrate the blue line of support. And the same thing holds true for the Qs, the NASDAQ 100. We're trapped between resistance and support. Again, a trading range as an individual already posted. So you guys are astute. Now the key is, what can we use to determine whether now's the time for this to break? You know, there's a little tool here that many traders look at in the content of breadth analysis called the advanced decline comparative ratio line. And another tool that's used is based off this one single stock index, which is called the New York Stock Exchange Composite Index, the NYSE. So generally, when you look at breadth analysis, the advancing stocks versus declining stocks. Another tool you would hear about would be the TRIN, or perhaps the ARMS indicator, Richard Arms. Another one is Sherman-McClellan, the McClellan oscillator, the old famous McClellan oscillator. You know, it does happen to give us both leading at times and lagging indicators. When we get to extreme oversold readings, like we did down in here, it tells us don't throw the baby in the bathwater out. When it gets to extreme overbought readings, it says don't be looking to get longer in the market. And I know that was not grammatically correct way of speaking, but you know my point. Right now, it's at a negative 50 reading on a daily chart, and we have a mixed reading of indicators. This advanced decline analysis right here reflects how many stocks on a cumulative basis advance versus decline on up or down days, right? One of the things that I find interesting is you can clearly see what we did on Monday. We started off the new year on not just a sour note, but a death spiral gap lower open. And when we opened lower, we actually closed just near these prior red candles closes, right? I mean, they're pretty darn close. I'm sure you would agree. Even this particular day right there, when we had a low reading, in fact, we are almost at the same level. But the advanced decline is not. I would be very panicky if the breadth analysis was making newer lows or at the same level, and then I would have to say, hey gang, we got some issues. But the NYSE is also not my one single sole reliable stock index. And here's why, and I want to share this with you. You heard me talk about it before. I've done it at various presentations. If you've seen me last year, I did some traveling to a lot of great groups. First and foremost, we saw you guys in the Long Island Stock Investors Group. Remember that? Someone had asked me, is the stock market going to be higher or lower by mid-October? And in August, I said, a week before the crash, I said, we're going to be lower. I mean, seasonally speaking, I guess I was lucky, right? We were lower, to say the least. The guys out in Sacramento, Orange County, I've been out to California a bunch of times, great option groups out there. Just recently at the Silicon Valley group, a lot of great traders out there, people struggling for good information to get better at trading. And you know, the thing is, we have decent tools out there to help us. And many of you have heard me teach and share these ideas. Well, I haven't changed. I mean, I'm still using them. And here's the thing. If you've heard me at those presentations, the one reason why I don't particularly put all my eggs or faith in the information such as the McClellan oscillator or the NYSE advanced decline is because first and foremost, out of the, I think, 1,800 stocks, 1/5 are foreign stocks. Over 50% of the stocks in there are interest rate sensitive weighted stocks, including bond funds valued in price. And then also energy. You have a lot of energy component stocks. So the worst performing sectors that we've seen are weighing in on that market. So that's why it has a different landscape versus the technology-laden Qs, right, which is biotech and technology, drug biotech and hardware technology names. You could throw in a couple other names like a Costco and a Starbucks and, you know, Tractor Supply, but for the most part, it's a different market. Not all indexes are created equally, and this is a society and a time frame of trading that funds, institutions, managers are so able and capable of moving billions of dollars worth of stocks at a push of a mouse. That's what's amazing to me. And you know, you constantly see this in the market. All of these types, one day their utilities are up, the next day the entire utility sector is down. One day we see the semis up, the next day the biotechs, and it's just one big sector rotational grind. That's probably indicative of this trading range. So with that said, first and foremost, the studies and indicators that I use, of course, seasonal analysis. Seasonal analysis by far helps anticipate market turns. Persons pivots in multiple time frames. They help me both uncover what Persons pivots does, and many of you have heard me talk about this before, so we're not going over Persons pivots today, but it is an indicator. It's not just giving you levels of support and resistance. It's giving us an indicator based on a behind-the-scene moving average component that says, hey, the next time frame, based on the moving average components, it's giving you a bullish and bearish outlook. Now, some of you do have thinkorswim. And if you take a look at a chart on anything, and this is the ES, the E-mini S&P, right? So on the charts here, I have daily Persons pivots. This is, what do I got here? A 1 hour chart. I got the daily Persons pivots with weekly. All right, so we are right now well below the weekly Persons pivot, which is this larger green. And the market needs to really see any sustainable upside momentum. We needed to get the market to get over the swing high of this last conditional change or get back above that fuchsia line. Today, we never did. Now, we did see a little uptick in the volume at the very end of the day, which is, I guess, you know, kind of promising, but it's not with the report coming out tomorrow. You know, for me to see a sustainable breakout for a market move, we need to see some giddy up and go. The call that I gave you that I see 1940, I see 2080 before 1940, you got to admit that's a pretty fair handicap in recent times, because I mean here the market is 70 handles away, 70 handles, just equidistance. I see, or 60 to the downside, 70 to the upside. So I'm actually handicapping myself. I'm screwing myself. I should have said 2070. But in the meantime, what I like to use on thinkorswim is, besides the buy and sell indicators, which are the PPS, if you go over to studies, you have, of course, just add a study and just find my name if you're not familiar with those buy and sell signals. And then incorporate them with the Persons pivots. Another incredibly useful tool is how we use these to scan for trading opportunities. So besides the Persons pivots, we use the other tool, which is incredibly useful, is the PPS buy and sell signals. Now, I did run this and I just went for an end of day study before we started, ran it in the S&P 500, and here are the list of names after today's trading session of stocks that generated a daily buy signal. Not a lot. Not a lot of new, fresh daily buy signals. Now, work with me here for a second. Real estate investment trust, investment trust, investment trust, real estate investment trust, real estate investment trust, real estate investment trust, investment trust, investment trust, investment trust. Out of the whole S&P 500, I had, out of this small population of 25 names that met the criteria of a buy signal, money was flowing into investment trusts. Now, here's another thing I want you to follow and look at. So when trading starts to get more predictable and you're starting to see us break out of a range, we run scans to find out where the money flow is going, right? So we know today what made the market move. Real estate investment trusts. That's number one. Number two, look at the a real estate investment trust. What was the percent change? 2.5%. What was the next one? Almost 2%. What was the next one? 2.3%. What was the next one? 2.4%. What was the next one? 2.4%. What was the next one? 3.85%. Okay, well, whoever this guy is, he was out of the norm. The next one, 2.17%, 2.8%, almost 2%. So what do you think the average is? Over 2% on average. Real estate investment trusts were starting to get bid up all about the same percentage amount. They're all priced differently, right? I mean, this is a $40 stock. This is a $90 stock. This is Avalon Bay, a $184 stock, but all on average up about 2%. So I'm seeing a confluence of stocks all up 2% and a strong concentration of them up over 2%. So something was going on in, again, here's one, Simon Property Group, up almost 2%, and it's $196. So what the person's pivot does is it helps us to define exact buy and sell signals and money flows in the market. How is that going to help you to make money? As a stock trader or an ETF trader, can you imagine if today we generated like boatload of biotechs? We could sit there and run scans during the day and find out where the money flow is going. And if their biotech is starting to see a concentration number of biotech firms up, all up about the same amount, that might influence the NASDAQ 100 or the Russell 2000. So day by day, we want to run these live scans. So next week, first and foremost, I wanted to say, hey, this week we've got, what a way to start 2016. Powerful tools, powerful equipment, powerful trading platforms. How do we put it together? How do we beat out the rest of the guys, right? If we can learn about and anticipate where the money flow is going, applying some seasonal analysis and using specific technical tools in the right combination, it's going to be a very exciting trading year again. I think what we do look at, and this momentum, this closing price compared to past price action, what we call, I guess I look at candle charts as we have of course, the famous high close and low close doji triggers. We also pay attention to what we call spread pairs and relative strength analysis. Corn versus beans, Pepsi versus Coke, Russell versus Dow, small cap, large cap, that type of stuff. These are all the crack spread. If crude oil is going to go up or if it's going to continue to go down, you can have all the crude oil out there, but if the demand for reformulated blend gasoline, diesel fuel, jet fuel is insatiable, then guess what? They're going to start eroding and taking off that crude inventory off the table. So, instead of paying attention to the spread between WTI and Brent, maybe we pay attention to reformulated blend gasoline. Da-ding. That might be a cause for concern. By the way, to prepare you for 2016, we also wanted to make mention and let you know about this. Last year, we did an incredible Person's Planet event. It was just our company, my group of traders. And we went to the Caribbean. on, I believe it was the Allure, the Royal Caribbean, largest, one of the top largest vessels out there. First class, great time. This summer, if you want to prepare for 2016, this summer we're doing a 7-day cruise. This time we're going to Europe. Great way to get education, coaching, trading, mingle, and hook up with people and pay it over time. This is an exciting trip. We're going to Europe. We're going to cruise around Europe and learn to trade in June, the 12th through the 19th in 2016. So we do have some exciting events coming up, and we are so looking forward to that cruise. It's going to be awesome. Top shelf all the way. So if you're interested, come visit the website. It's on the front of the website next to my tweets. You can find the tweets in the landing page right there if you're not familiar with that. I just wanted to post to you what else is going on in Person's Planet World. Here it is, guys. Seminar at Sea, right under the tweets there. Okay? So with that said, this is, besides that big event and the upcoming election, right, we want to start to focus in on a lot of seasonal tendencies. And January, my friend and co-author of the Commodity Traders Almanac, his father started this publication 49 years ago called the Stock Traders Almanac. And in there we had this thing called As January Goes, the Rest of the Year. And the first 5 days, well, I'm not sure how the first 5 days are looking right now, but we are down. And I don't think we're going to be seeing a continued rip-roaring bull market, especially since we have so much indecisiveness looming still with the Fed and the presidential election. But remember, not all stocks go down, and I don't see at this point in time the makings of a significant market crash like we had through 7 and 8. It just, everything isn't lining up. We might have corrections in certain markets, and other sectors, like I shared with you in the transportation, they've already been through a corrective phase since peaking out in late 2014. So with that said, we really want to pay attention to seasonal analysis because it has been extremely reliable with these caveats. Listen carefully. Caveat number 1, I always pay attention to a market that's out of sync with its seasonal tendencies. If it's supposed to go down and it went up, it's out of sync with its seasonal tendency. If a market's supposed to go down and it does, then it's in sync with its current seasonal tendency. So when we expect to see a market bottom out and see a seasonally strong period of time, I give it a higher probability that it will coincide with its current seasonal tendency. And I guess that's why the con side of the pro and con sheet says it doesn't, not all years are created equal, but it gives us a better price forecasting model, tells us what sectors can we focus in on. If we start to see seasonal strength in XYZ sector or utilities, it might give us a better explanation as to why certain markets aren't behaving to the norm. Gold, for example, it has a tendency to rise a bit in early January, and then the worst time of the year to buy gold is at the end of this month, friends. Relative to silver, silver outperforms gold. So therefore, it's not that all mining companies might go down if gold goes down, but the ones that have silver, and if silver demand picks up, then you will not see silver go down hard as relative than gold, if that makes sense. All right? So there is a way to study seasonal analysis. I think seasonal analysis best explained is simply this. Technicals supersede all seasonal tendencies. Technicals is not price-based indicators, but it's yet volume and open interest. And you got to be a little bit aware of what's happening on a macroeconomic environment. If we are in an economic contraction globally, if we're starting to see contraction, if China does not start to come out of this, let's call it soft landing for right now. Let's just leave that term on the table, China's soft landing. If it doesn't see recovery, and if we don't see a pickup in demand for industrial metals, whether it's steel, zinc, or even copper, then when we enter a seasonally strong period of time for those metals, you're going to expect a muted upside move. But all of a sudden, if we start to see strength in China's economy, you can probably anticipate increased demand for those products, and therefore we're going to see a more heightened or expanded, magnified move. So that's why it's important, why I kind of link it all together. It's not that complicated when you really sit down and think about it. Where are we in the business cycle is how we started off. What are we looking at as far as a market heading into 2016? In order to answer that, I said we got to figure out where these markets have come from. And as you notice, when we look at the longer term charts, you go, wait a minute, man, some of these areas have had blistering rallies that you may not have paid attention to, whereas the short-term charts, if you didn't go back far enough, they look ugly, but the longer-term charts look like we're in a trading range after a wild upside move in 2013, such as the example of the transportations. So with that said, I want to leave you with this. This, again, what did I say? Markets that are in sync with seasonal tendencies tend to remain in sync with seasonal tendencies. Crude oil, or at least not crude oil, but the XLE, Energy Select Spider ETF. Now that's diversified. It's got a few XOP names in there. It's got some refiners in there. It's got a few oil service sector stocks in there. But the XLE typically bottoms out, in October, chops around, has a secondary bottom in November, chops around. December it bottoms out, rallies going in the first part of the year, it drops off. And we actually kind of saw that, right? But towards the end of the month, give or take a week, towards the end of the month, this is the one sector that really starts to see appreciable valuation. So for stock traders and for those interested in day trading E-mini S&Ps, so this is the tie-off. If you're a day trader E-mini S&Ps, it really does help to know when can you trust buy signals and when can you trust sell signals, right? If we're coming out of a basing action and we're in a trading range, and by the next couple weeks we see energy start to recover and energy stocks to recover, it's going to have a huge weighted effect on the S&Ps, and we could see that 2080 call to the upside. So I wanted to alert you guys to that and say, listen, we've got a lot of things to cover, and I wanted to do a two-part to go over where are we in the business cycle. I wanted to go over what tools are we using, what have I got my eye on, and what are my 4 top indicators if I got stuck on an island that I want information to. Now, next week, we're going to talk about determining directional trade ideas, setups. We're going to talk about execution, triggers. I'm also going to go through a little bit about trade management, my risk, reward, and order placement. How many times have you guys been in a trade and it's a real busy day, you see the overnight action just like August 24th, right? And you got some prop and you're going to make money. You're in a profitable trade. Maybe you're in puts and the market's crashed. You can see that the overnight session and you're in some maybe ETFs that don't trade 24 hours. You don't have access to the pre-session. And you go to liquidate your position and then all of a sudden the internet goes down on you or the platform is slow in functioning, right? So we want to think a little bit ahead in how to determine order placements for liquidation offsetting orders to get ahead of the curve. I don't think it doesn't matter whatever platform you have, we are all subjected to the internet working 100%. And Murphy's Law states when everyone's trading and there's big volumes and there's big things happening in the world, that's the day the internet's going to have a problem and you won't be able to get out of a trade. Well, we've got a solution. Place orders. We'll talk about it more next week. And again, one of my favorite topics is position sizing guidelines. There's an old phrase from the old days. Whenever you're right, you're always in 1, and whenever you're wrong, you're always in 100. Some people say, I can't lose on this trade. I'm going all in. And then it loses, and then they have nothing more to trade. We need to be consistent in the amount of allocation and equity that you put towards a trade, whether it's an underlying or an option. And I'm going to give you some guidelines next week. So I really wanted to get a good start, a kickoff to 2016. Started off with, and I know that there's just probably just an unbelievable amount of market insight information out there that we might be bombarded with. So I wanted to kind of kick it off a little bit early and record it and give you a chance to review it this session over the weekend. And then when we come back in on Tuesday, it'll be a little bit more cheery, and then we'll get the minutes of the FOMC out of the way, we'll get the unemployment out of the way, and then we'll see how we stand after the first 5 days of January, and we'll talk about the technical aspect of the market and what trades are looking good for the rest of January besides the XLE. So I really look forward to seeing everybody next week. So that does conclude today's first installment of our two-part webinar series kicking off 2016. I hope you enjoyed today. Again, if you have any questions that you had that weren't answered, may I direct you to a couple things. First, before we get there, I love this guy. He just looks, he's like, you know, full of confidence. I forgot his name. He's somebody, a statue. He's actually, it's a park in Paris, actually, right on Champs-Élysées. Feeling confident. You know, we feel confident because we feel confident in our skills and the tools, because we execute based on a plan. Whether you win, lose, or draw, if you trade it on a plan, it is what it is, and you're gonna over time succeed in the markets. I think many traders put too many pressures on themselves. They might expect too much out of the market. They may expect too much for the size account that they have. They're forcing themselves to get rich quick, and you can't. There is no get rich quick strategy in this world. It's called a scam, right? Maybe you can hit a nice trade and have a heavy position on it when everything's lining up and you have decent risk capital at hand. Then you could use a directional trade and go with it. But 9 times out of 10, the majority of traders, it's taking trades one trade at a time, not the big home runs. And I never did believe, you know, my phrase, many of you guys know me, I'm more of a directional trader. I think that there, with 7,000 stocks, 32 commodities out there, we can find trade setups. Even today, when the markets were not doing a whole lot earlier this morning, I was talking about, hey guys, let's look at this commodity stuff. Even lean hogs started to see some volatility and some moves. So a good trader doesn't get fixated on one market. You have to be able to be diversified. Anyway, I look forward to having you guys join us next Tuesday. All right? And if you do have questions, you can email us here, johnp@personsplanet.com. There's the website. Let me go over the website with you one more time. We have some amazing things there, especially if you go under Tools. You'll see right there it says Instructional Videos. And probably, perhaps, today's video will be up there in a short order. But lots of stuff there, how we use different indicators. We did one with David Keir from TOS last month, and on what's new on Thinkorswim. And I think we even, in that video, it talks about how to set up your scans, which was really cool, using the PPS indicator. So if you're looking for more information about my methodology and how to apply platforms like TradeStation or Genesis, here's where you can find all of these videos. Didn't require you to give your name, rank, serial number, birth date. It's just right there for the taking. Okay? So with that said, everyone, have a great rest of the week. For my members, thank you for being here. Many of you, I know, were probably bored to death because we covered a lot of this in the trading room today, especially looking at those REITs this morning. And with that said, I'll see everybody here. When will I see you? For you guys visiting, I'll see you next Tuesday, same time, 4:30. This time I'll try to make it on time, or maybe it'll be 4:36. And for everyone else, I'll see you tomorrow morning. Thanks, everybody. Be good. Guess what? It was recorded. I mean, it says it was recorded. So that's a good start. Gary N. Oh my Lord, my friend, how are you? Where's Gary N? Gary N. Gary, are you still here? Oh my Lord, Gary. Oh, I see you, brother. Oh man. We'll say a prayer for you for speedy recovery. I mean that too. You know me, Gary. Prayers are in order for you. Okay? God bless you, brother. Seriously. Rick's from, looks like I missed a couple things. JP says, JP, I got in late. We have the recording of the first session up. I don't know when, sometime shortly, today, tomorrow, tonight, tomorrow. Let's go tomorrow. We'll do tomorrow since it's already tonight. Stephen P., thanks for coming to Long Island to see us. Yes, sir. Judy, do I have a non-trading relative out of Australia who can set up a paper account? I don't. I don't have a relative in Australia. So, I'm just going through to see if I missed any questions that were there. And a lot of questions will be answered actually next week too. So cool. Jerome, how are you? Happy New Year to you. And I'm glad you're doing better, Gary. That's, my goodness. God bless Gary. That's for sure. A lot of Garrison as well. Hang in there, my friend. You got a lot of good people here wishing you well. All right. So, and for those, as a reminder, I know that we still got a lot of people left in the room here. I forgot to mention, we have that 3-lesson class. The mentoring session will start this week, Saturday. We have that. So we will go that. All right, that's it. I'll see everybody. When will I see you? I will see you Tuesday. And for those that are coming to our 3-week mentoring online class, I'll see you Saturday.